Shanghai is up 1%, Nikkei up 1.1%.
After our November meeting, we noted that we anticipated that ongoing rate increases will be appropriate in order to attain a policy stance that is sufficiently restrictive to move inflation down to 2% over time.
Markets have made fresh all-time highs, and IT index, well, that's flying away.
The positivity around this time is on the back of the dollar having peaked out. I mean, that's my assumption.
The input gas cost of APM gas would come down by around 24%.
The decline is entirely explained by the base effect.
You must think of this e-rupee as cash in your purse.
Brokerages are of the view it will reduce gas costs for all these city gas distribution companies.
We're holding up in the green. It's still positive, a gain of close to about 0.5%. This would make it the 8th consecutive day of gains for a market.
Department of Financial Services has said that issuance of composite licenses should be approved.
Companies which had been issued an official action indicated status earlier, which essentially means the US drug regulator can withhold approvals from the plant.
Many are saying that this is a triangular fight in Gujarat with the entry of Aam Aadmi Party.
There is some fall from the highs. Bank Nifty is in the red right now.
Well, that was the day so far. You're with us here on a fresh new edition of Closing Bell. I'm Prashant. Nigel and Rima are with me. Guys, hi, good afternoon. Things are looking okay. We're off the highs, but the market is not selling off or anything of that sort. We still have about 0.5%. And if you just look at the last 4 sessions, what we have is, first of all, this is the 8th day of gains. But more importantly, for the last 4 days, we basically have higher lows and higher highs, which I think is exactly the structure that you want on the Nifty. And more often than not, I mean, we had kind of pullbacks in small caps and mid caps as well. But more often than not, that part of the market is also coming along nicely. I mean, actually, the small cap and mid cap indices are up about 0.5, 0.75% respectively. Bank Nifty, it fell sharply. Actually, that is the index which fell very sharply into the red. But that is also, as we begin 230, it's starting to see a pullback. Once again, it's higher, some 60, 70 points, mild. But from the lows, you can see on the intraday, it's seen a sharp recovery. And IT and metals, as we were saying right from the morning, that is what is leading the charge for the bulls. And there are specific triggers, reasons. We'll talk about that. FMCG is seeing some pullback, and the government stocks are seeing a little bit of pressure as well. Rima, hi.
Hi, Prashant. Hi, Nigel. We went down to levels of 18,000, but there some buying has emerged. So that's a positive that markets are trying to, the bottom is not falling off today. And it's largely been a good day, right? Minus that volatility that we saw around 2 p.m. The benchmark indices are up close to about 0.4%. Auto sales have been trickling in, so we'll discuss that in greater detail. Post 3 p.m., watch out for the weekly expiry option moves in tomorrow. We've got that all-important U.S. Jobs data, and that will feed into the FOMC meet. That, as well as the U.S. CPI inflation data, which will come out on 13th of December. These will be the 2 important data points going into the FOMC meet. So from now to Friday, that's what the street is going to be tracking very closely, Nigel.
Well, that's right, but we have expiry that's going to play out in the next 60 minutes or so. And there's a fair bit of action on the call as well as on the put side. So let's start off with the call side first. There is a sense of there is some writing at around the 18,900 call. Well, that's added close to 1.7 crore shares. So very aggressive writing out there. And the street is playing that we're not going to get past that level. But the 18,850 call as well, that's seeing a fair bit of open interest. 1.4 crore shares added at that strike. The premium out there is around 17 rupees. While on the downside, the 18,800 put as well is very active. So there's a sense that there is writing at all these 3 strikes. Let's plug in the numbers then. On the downside, since the 18,800 put is seeing fair bit of action, well, you're taking an average that the premium, the weighted average could be around 25 rupees or so. So 18,800 minus 25, that's give you 18,775. That should be a bit of a support zone out there. And that's the range that they're playing for. On the upside, however, today we made a high at around 18,888. And that should be a bit of a, resistance zone. Or to a short point being that, the bears are playing that these 18,875 to around 18,885, well, that will hold out. So that's the broad 120-point band that we're working with. Let's see whether or not that holds out. Exciting 60 minutes coming up as always. Rima?
Indeed, and it's a power-packed show on Closing Bell today. So first up, we'll talk about how mid-caps are outperforming the large-cap pairs, even as the Nifty and the sensex scale fresh record highs. Powered by a global risk-on rally, the mid-cap IT pack surges as the street begins to price in the likelihood of smaller rate hikes by central banks. The cement sector stocks are also higher in trade. What's gotten these stocks excited? Details on the show. Paytm will be on our radar as they will be hosting an analyst investor meet later today. And it's a mixed bag of sales for the automakers in the month of November. Complete analysis on all the individual numbers coming up on Closing Bell. And finally, we'll be joined by our Alpha Manager for the day, Aditya Sood of Incred PMS, to discuss his top portfolio bets.
Well, how should you position yourself in this last hour of trade? That's the question. Let's put that to Mitesh, who's joining us. Mitesh, hi. So we, I think, find ourselves in a similar situation when we spoke at about, 10:10 or so. There was, markets were higher, but there was a bit of a dip emerging. We're up 80 points, not at the day's high, but it's solid once again. What should one do near term?
Afternoon, Prashant. This is a typical question which every trader faces as the market continues to scale new highs. I think we keep getting overbought on the short-term chart, which is the hourly and the 2-hourly charts, and yet we don't have a sign of a pullback. Just trail your stop losses. I think that's the only fair way of doing it. And now I think the level should be closer to about 18,725, and hold on to long positions. No need to cut it because there's no sign of a strong supply or a reversal happening immediately. So till that happens, I think let's try and ride this as much as possible. On the stock side, overall reality is something which has got my focus. A good breakout over here. That's a buy with a stop of 934, targets of 975. And India Cement is another one which is turning on the upside. That's a buy with a stop below levels of 241 for targets of 260.
Okay, all right, got that, Mitesh. Thanks a lot for that. Well, we have Prakash Diwan as well that's joining in. Prakash, I'm going to come straight to you, but we want to discuss some of these stocks that are buzzing around. And a lot of these domestic players are doing well. What I'm talking about is cement. And cement stocks are buzzing in today's trading session. And I've zeroed down on 3 big factors. One is input costs, they've cooled off. What is that? Pet coke prices. They've been lowered by close to 6% on a month-to-month basis for the month of December. So that's pretty good news because domestic pet coke prices have come down. However, I understand that international pet coke prices haven't corrected that much. The tailwind, though, is that even coal prices, we're looking at an index-traded number, which is around $250 per ton. But the actual rates the trades are happening, or the actual coal movement is happening at a sharply lower price in comparison to what the index is showing. Index price is showing at around $250 per ton. However, if you're importing either from Australia or the United States or South Africa, well, that range is around $140 to around $190 per ton. So it's sharply low in comparison to the index price. Lower input cost, that's something that the street likes. Next up, demand recovery was visible in the month of November. Remember, for October, we had the festive season and demand was a little bit subdued. But in the month of November, I understand that demand has bounced back fairly decently. Though parts of the country, there is still some impact on demand. Like there are Gujarat elections that are taking place, so it could be impacted out there. You have construction ban in various parts of northern India. And sand availability issues, well, they're plaguing some parts of Punjab. The third factor is at play is that cement prices are up by roughly around 2 to around 2.5%. South and east, the traction is higher out there. Pricing increases have been higher out there. While expectations are that maybe there'll be some bit of a push through of a price increase in the month of December as well. So all these 3 factors put it together, some of the cement stocks are doing well. That's input costs are cooling off, demand is bouncing back, and prices as well are holding strong. Well, Prakash, you heard what I had to say on the 3 factors, but how would you approach this space? The Dalmia Bharat is a darling for you. From around 1,200, 1,300, you have been saying that you like that. Would you stick to that one, or do you like something else from the cement pack? Go ahead.
Good afternoon, Nigel. So I think that was indeed very comprehensive. Not much for me to add to it, but the screen is very clearly telling you that they're listening to your attribution on why things are so positive for this. And let me also just add one more factor that you could probably verify with some channel checks. The last GDP number that we saw yesterday did report a little bit of a softness in construction. The numbers didn't look very impressive. And that's precisely where all of that has been pushed into this quarter and probably will continue in the Jan-Feb-March quarter, given that we had a slightly longer monsoon and a delayed monsoon. So coupled with that, you had a few temporary suppressants of sorts in terms of, the festive season taking off, a little bit of the sheet from construction activity, workers taking holidays, things like that. And there's a serious issue in terms of in terms of the construction activity, there's a serious issue in terms of even labor shortages in some of the larger markets because people haven't come back in full gusto, post the COVID, this thing. So all of that is taking a little bit of a time for cement to kind of start seeing that rub-off effect. Otherwise there is no way cement prices would have been hiked and it would have. In fact, I'm hearing about a potential hike in December as well. So if that were to happen, and that's probably being flagged off or led by the newest player in town, and that's Ambuja. So they are the ones who probably will herald a little bit of a price hike in some of the pockets. From what seems like a very clear sweet spot to be in from a demand and input cost perspective, I think the East is something which could grow dramatically. So while I do like Dalmia Bharat, but the numbers that I'm seeing in terms of reportage of sales from the Dealers Association tell you that the pickup in East is far more. The focus of the government in terms of infrastructure and the private sector participation in housing projects is very phenomenal. So that is something where a Nuvoco Vistas could be probably looked at. I mean, this is a company which has not been very profitable given the cost structure that it inherited and all. But the way things are, I think it offers you a very good geographical presence in terms of leveraging on all that growth. But even as a sector, I think for the next 12 months, you'll definitely find cement. And we've spoken about this, that cement is a spot to be in, irrespective of volatility on the prices. But the business seems to be much more secure than probably the last 2-3 years, thanks to the pandemic slowdown. But all of that recovery will probably start benefiting most of them. Some of them will probably get disproportionately favored and benefited, and that's what you need to look.
By the way, Maruti's total sales are out on your screen. Total sales have gone up by 14.5% on a year-on-year basis. But this is slightly lower than the 21% that the street was anticipating. But there is good growth that we've seen on a year-on-year basis. If you compare it to the prior month, that's the month of October, which had the benefit of the festive season, because this time the festive season fell in the month of October for us, Diwali, Dussehra, etc., it would be lower. 1.59 lakh units in November would compare with 1.67 lakh units. So there is a month-on-month drop-off that we have seen for Maruti on a month-on-month basis, but on a year-on-year basis, it's still clocking in very good growth, close to about 14.5%, though slightly lower than some of the estimates which are out there on the screen. Let's just pull up the intraday chart of Maruti. Well, Maruti had that big up move at about 12:15, and after that, it's largely stayed. So these November auto sales have not moved the needle on the stock price of Maruti. So the markets have digested the numbers, at least for now. But the other stock that's buzzing in trade ahead of the company's analyst meet, which is scheduled today at 5 p.m., is Paytm. So Paytm is up 3.5%. Vivek is here to tell us more. Vivek, do you have anything that the street is anticipating?
Well, that's right. So Paytm, as you rightly mentioned, the analyst meet is held today, and this is the first analyst meet that the company is holding after the listing. It's always been the conference call post earnings. So what actually the market is anticipating is that number one, prominent investors, prominent sell-side analysts are expected to attend. The management recently also has guided, to achieve an adjusted break-even, EBITDA break-even by September 2023. So most of the analysts are going to hold the management onto that. And also, when you're talking about what exactly has happened in Paytm in terms of a technical overhang. Post the ending or the expiry of the lock-in on November 15, 2022, you're actually seeing prominent investors sell out. So SoftBank, that had a little over 17% stake, sold almost 4.5% stake in the company. And a lot of analysts, a lot of brokerages have highlighted that this particular sellout by pre-existing investors is something that could continue. However, when you're talking about Paytm, remember the stock had fallen almost 75% from its IPO price. However, in recent times, post the price fall, as well as post Q2, there have been a couple of brokerage upgrades that have come in, and a prominent one among them being CLSA. So CLSA upgraded Paytm on November 28th from a sell to a buy stance, and what they're saying is that the company actually has more than $1 billion in cash on the balance sheet, and the cash burn is something that they expect to end in another 4 to 6 quarters. They believe going forward, loan and credit card distribution would be revenue growth drivers. So all of this is something that will be keenly anticipated post today's analyst meet.
Vivek, thanks very much for that. So, Rima, the question is, what can they say, right, in that analyst meet? It's an analyst meet, so it's to be given that it will be positive. I mean, there's no other reason to hold it in any case. But can they say something substantial, maybe use of cash? That is essentially, I think, what Vivek also mentioned.
Yeah.
one doesn't know.
I think they're $1 billion of cash, right? Out of a market cap of $3.5 billion.
Yeah, so a third of the market cap is cash. But
yeah,
but that cash is needed, right? Because the quarterly burn, etc. So it's not as if what all options open. And the price, of course, has seen a catastrophic fall. So in that context, this analyst meet is being held. So we'll have to wait it out. Prakash, in your opinion, I mean, how are things set? There is interest. I mean, people that one speaks with, at the margin, there is interest. I mean, at least from a price perspective, or in all these stocks, not just Paytm, but PB Fintech, Nykaa, etc. Go on.
Yeah, absolutely, Prashant. I think the price erosion kind of makes you feel that, can you still go wrong at this level? 80% erosion or whatever, 75 whereabouts is significant. So, that whole thing of being overpriced in those exuberant times has probably, corrected itself. And now when you compare it with the business proposition or what is it that they have as the vision to kind of start growing or monetizing some of the franchise that they've created, which is such a strong one. I mean, I think they do have this presence which is formidable. They do have a mechanism and a process which is absolutely in place. It's a question of what is it that they can do to start making some money out of this, right? So if there are plans in that direction, even if it's, let's say, 2 years, in the distant future, it will still be regarded as positive result, because people are yearning to hear something which not only makes sense from a capital allocation perspective, but also in terms of what is it that they have in terms of, taking the plunge in terms of monetizing some of these businesses that they have. But there are a lot of these grey clouds hanging in terms of, the RBI restrictions, the kind of strictures that they have to operate within. So all of that means that there's going to be a lid on it. But the overhang, the supply overhang from some of the larger investors who bought at such phenomenally high levels, that is out of the way. So you know that you will not really stare at the screen where there's another sharp cut just on one good day and then the bullet hits you. So that from that perspective, people will start nibbling into it, is my guess, and nobody's going to rush into it. So let's wait. The analyst meet is going to be, it's timed very well in terms of the opportunity to restore confidence is definitely there, but I hope they live up to it. I would rather listen to them and then kind of take a call. But things look probably less worse than what this was, let's say, a month back.
And they've anyway indicated their path to profitability, right? In Q2, they said they're on track to deliver their stated guidance of adjusted EBITDA break-even by September of next year. But I guess there will be a lot of hard questions that the management will have to face, and it could decide whether these long-term pre-IPO investors want to continue to stay on or whether they'll sell. So I guess this one is going to assume a lot of importance. Get into a break. On the other side, we'll be joined by our Alpha Manager of the Day, Aditya Sood of Incred PMS, to discuss the stock portfolio bets, and we'll continue our conversation with Prakash Diwan as well. Welcome back. The day belongs to the technology names. The Nifty IT index is up 2.5%, and the rally didn't start today. The rally's been ongoing for the last couple of days. In fact, from 1st October, if you take a month to date, last 1 month, the Nifty IT index is up close to about 8.5%. But today, of course, we've seen that powerful up move. So what's driving it? One, we're seeing that some of the valuation derating, which took place in Indian IT names from the beginning of the year on the back of higher rates in the United States, that valuation derating is now reversing. So it's not that earnings estimates have changed, but some of the valuation correction is now reversing. Also, these stocks are significantly away from their 52-week highs at a time when the markets are continuously hitting record high levels, right? For some of the large cap IT names, the distance to the top is about 15%, but for some of the others like Wipro and Tech Mahindra, it's almost 40-45% away from its 52-week high levels. Take a picture, take the the similar thing on the mid cap end as well, and you can see, right, between 10 to about 34%. That's the gap from the levels today versus their all-time high levels. What is it that the street is going to watch? As I said, today is just some of the underperformance is getting reversed, is getting corrected, right? Q3 is typically a seasonally weak quarter because many of their clients decide to shut shop for maintenance because of low Christmas demand, etc. But this time, are the Q3 furloughs going to be more than usual? If that's the case, then it's an indication of weakening demand. That's point number one. Secondly, it all boils down to what happens in the US. They get like 90% of their revenues, 95% of their revenues from the export market. And here Credit Suisse has done some interesting analysis. They're saying there is a very strong correlation of Indian IT companies' revenues to US GDP. So the current consensus is that next year US real GDP growth will be 0.6%. If that's the case, then IT companies will see a 7.5% constant currency revenue growth. But if US GDP turns out to be far worse, it's not a soft landing, things get ugly, and US GDP is minus 1%, then the Indian IT companies' growth rate will fall down to 5.7%, and that will also drive a further derating. And the converse happens, right? If the US growth turns out to be a lot stronger than it is anticipated, today, and then growth rates could be even in double digits. So it really depends on what happens, on the global front and the US economy. And I guess we will have clarity only when the IT companies report their numbers at the beginning of January, because soon, I think from 15 December, they'll go into a silent period, and generally these companies are fairly tight-lipped about giving you a numerical guidance. So we'll get a picture in January about what the client budgets are looking like, and are the companies, their clients, curtailing or cutting back on some of the tech spends. But that's the picture when it comes to IT today, which is leading from the front. Prakash, any thoughts on IT, anything that you would recommend buying?
So, I have been echoing the same thing that you'll probably see a little bit of a flash in terms of interest for IT companies given the, low valuations that prevail. And, the market's in an exuberant mood to reward something that's got hope and that's got promise. But the key thing is all this execution that you see in the current year is legacy contracts. I mean, what's going to happen is subsequently to newer contracts or the kind of nature of contracts in terms of margin profiles and all, that's going to be very critical. And that would probably take some time, not just the result season, but probably, end of Jan to get that clarity. So that's where you have longer term visibility coming in terms of the revenues. But, while mid-cap IT has performed because they tend to be much more resilient in certain times where they're not dependent on very significant size contracts to continue that growth trajectory, and even the smaller things add up quite a bit. But it's going to be some of the larger businesses that I personally feel are going to be very promising. So Tech Mahindra, case in point, I've been talking about this from sub 1,000 levels. Now everybody will come out of the woodwork and say, oh, I also told you to buy it at so-and-so level. But the key thing out here is some of them will start getting resilience premium, in terms of their ability to do it, even when there's a slowdown in the rest of the sector. So focus on those companies which have some sort of a USP, some sort of an edge over others. The likes of Wipro and all would probably continue to languish a bit because there's really not much in the consultancy side which is helping them out. But I think the likes of Happiest Minds or probably Tech Mahindra on the larger side, those are the ones that you stick around with and you probably get rewarded, is my guess. But most decisively, it's going to be January that you'll probably see everything getting clear.
Okay, all right. Prakash, as we speak, we're getting the Mahindra & Mahindra numbers that should come up for our viewers on the screen as well. And as we speak, it's looking a little bit better than what we were working with. Escorts Kubota came earlier today and that stock is flying away. What's your choice from this farm equipment space? What would you go in for?
So, I think what Escorts did, apart from the numbers, Nigel, while you do look at numbers to make some sort of immediacy in terms of outlook, what's important is the Kubota outlook, which was shared recently, is very strong. And as I said, typically Japanese great visibility for the next 2-3 years. They know what products are missing in the portfolio and how they'll plug that gap. And once that happens, I think they have the ability to withstand slowdowns as and when they come, and their ability to be part of a global market at some point in time where they can use parts of the facility here to outsource to other markets, which they are very strong in, especially in Southeast Asia. That's going to be a very big factor for Escorts Kubota, and that's what the market is rewarding them for. Mahindra is probably a PV play, more of a PV play right now, with more and more SUVs, electrification on the other side. So I think the tractor business is not going to be very big for Mahindra in terms of a game changer. But Escorts definitely from the farm equipment is a standout. It's like Ashok Leyland and Tata Motors. Both of them are doing well on commercial vehicles, but Ashok Leyland definitely seems to be marching ahead. The same thing probably the case in Escorts vis-a-vis the farm equipment.
All right, Prakash, thanks very much. Great speaking with you. Always a pleasure having you with us here on the channel. Thanks indeed. Our Alpha Manager of the day is with us. He's Aditya Sood, Portfolio Manager at Incred PMS. Aditya, good to have you with us here. Thank you very much for your time. You know, while the markets may look like a very easy, a dreamy kind of place for investors, is it so? Especially when you're handling, client money, because by most yardstick, headline valuations, of course, are maybe a little stretched. So you're investing into a market which has done very, very well. Broadly, what's the strategy that you're following across sectors?
Yeah, so I think so. The first point that all of us should keep in mind is that it has been a very turbulent past 1 year, and reasons have been multiple. Obviously, inflation surprised most of us. Most of us have not managed money in an environment wherein domestic market we have seen 10% upwards of inflation number. Secondly, I think so the market seems to be taking things on its stride, and what matters to most investors today is whether we'll have a pivot as far as the Fed is concerned on the interest rate side. But the key question there is that whether we are getting into an environment wherein we'll have higher rates, which obviously impacts equity risk premium. That readjustment is already behind us. Secondly, a key focus area for us from a global macro standpoint has been whether there is a policy pivot from China, which will come through in terms of the zero COVID policy. That might surprise a lot of people as we get into the new year. From a market standpoint, there are clearly divergences. So if you look at, for example, rolling returns of small cap index versus Nifty, there is a 10% divergence. Obviously, a lot of small caps have corrected by 20-30%. There are ample opportunities in this divergence. We continue to focus on companies wherein there is ample room for a gross margin expansion to happen, because what we have seen in the current earnings season is that EBITDA margins have been under pressure, but that is essentially on account of elevated freight cost, which is normalizing at this point in time. And it is also a combination of elevated energy costs. Thankfully, energy prices have declined by 40-odd% from its peak, and now inflation expectation seems to be abating. So our view is that this is a constructive environment for stock picking. Most of the sectors offer opportunities in terms of focusing on companies wherein PE multiples can expand and margins can mean revert.
Aditya, afternoon. Let's talk about stock picking then, right? That's the way to go. You're seeing value emerge in the IT space. I remember the last time you spoke, you said that you're adding Intellect Design Arena. Any other stock in the mid-cap IT space which is looking attractive to you?
Sure. So we have held, Tech Mahindra for quite some time. We are fairly constructive on the prospects of engineering, research, design companies within IT. I think so. The challenging aspect of investing into IT, let's say 1 year back, was valuations were very elevated. Today, that is not a challenging aspect. I think so. The key critical question going forward from here is that whether demand is going to hold on, or whether you can align yourself into companies wherein you have a very strong sectoral leadership emerging. And as we are aware that, Tech Mahindra is having 40% of its revenues coming from telecom. And obviously, as 5G rollout happens, they would tend to gain. More importantly, there is a leadership transition which is there. We have been holding the stock for last 3 years. And we are absolutely comfortable holding, large cap IT, things like HCL Tech we have held in the past. So we continue to be very, very constructive in this space. Intellect Design Arena was a recent introduction in the portfolio. What we do believe is that, there is ample room for mean reversion in terms of margins. For a company like Intellect, which is more focused on the product side, obviously there is ample room for margins to expand from here on. But the key here is that, one has to take a slightly medium to long-term call, which is possibly a 2-3 year call. And what we have also seen in terms of margin levers is that, Indian IT companies historically, they have gained market share in a down cycle. Secondly, there are a lot of cost levers that these companies have. And we do believe that, in a down cycle, those cost levers come to fore and margins would stay protected. Obviously demand is a great factor here, and our belief is that demand should be stable.
Okay, hi Aditya. Since it's the start of the month, well, we are talking a lot about auto names. How do you approach the space? I recall when we charted last, you were talking about a forgings player, that's Forgings, that has valuation comfort. What else do you like from this space?
So we have Higashi Motors, we have which is predominantly supplying motors. We have Forging in the portfolio. We are also looking at commercial vehicle companies, wherein, forging companies, obviously Forging is a key player here. And this is essentially in line with our theme, wherein we believe that India is going to have a multi-year cycle wherein manufacturing should do well. Within manufacturing, if you have got a, space wherein companies benefit structurally, it could be a combination of having a leadership position on the forging side. Obviously, Forging has that. They have suffered a lot because of, steel prices being slightly elevated over the past 6 months. That pressure is off the table now. And secondly, freight cost. Freight cost for most of these companies had doubled. So I believe that, there is a good room for EBITDA and operating margins, gross margins to also expand going forward. Obviously, demand is reasonably strong, be it the Class 8 trucks in the US or the domestic MHCV cycle. So both the cycles are in favor as far as the auto ancillary companies are concerned. So we have been reasonably constructive on this space.
In manufacturing, what about the electronics manufacturing services, the EMS space? We have, I think, 2 recent entries. There is Syrma, there is Keynes, there are things like Dixon, Amber. Anything interests you there?
So, generally, we have been avoiding a lot of these companies which have got recently IPO'd, and our focus has been to focus on companies, once the euphoria once the companies are beaten down, we typically look at a 3 to 5 year cycle to position ourselves. But what we want is a comfort of valuation. So there are not so obvious companies in this space which are not, extremely expensive. Generally, we find this space, to be reasonably expensive because most of these companies are getting listed at, 50 times a trailing multiple, so on and so forth. So PLI in electronic manufacturing, I would say that we would like to, at this point in time, avoid purely because of valuations. Even though the demand headwind, there is a demand tailwind which is there, we have been avoiding the space generally.
Okay, all right. Final question, Aditya, before we let you go then, from the financial and banking space, I think you had liked these smaller banks. And on the holding companies, you had reshuffled your portfolio. I think you had sold IDFC and you got into Equitas holding. From here on, what are you positive on?
So we have been very constructive on a company known as Chola Financial Holding, which obviously is a holding company of the NBFC, but more importantly, it also has a general insurance business. Now, if you look at this company, if you have to value either of the pieces, either you value the NBFC with a holdco discount or you value the general insurance piece. One of the businesses is free, and it has been a long-term holding for us. Equitas holding and Catholic Syrian Bank, CSB, is something that we really like at this juncture. And in this space, what we have seen over the last month or so is that, obviously PSU banks have done very, very well. I do believe that, there is a lot of disbelief as far as small cap private sector banks are concerned. Both these banks have a ROA which is higher than 1.5, which is a filter that we use in terms of, having asset quality. Obviously has not been a problem for most of these banks. They have traded at northwards of 2 times price to book in the past. So we have got, a considerable expansion, mean reversion here in terms of expansion multiple, and then obviously loan growth continues to trend well. So we believe that both these companies, CSB and Equitas, are a reasonable place in the banking space.
All right. It's been good talking to you, Aditya. Thanks so much for stopping by, sharing your views on a whole host of sectors as well as individual stocks. Wishing you a good week ahead and a cracking weekend as well. Well, before we slip into a short break, we have the markets more or less steady with a gain of closer on 70 points. The Nifty Bank is doing a relative underperformance, but maybe in the next few minutes we could see a bit of a move as we play out expiry. Slip into a short break. On the other side, Nimesh is waiting for us. He'll tell us what's going on in dealing rooms. Our technical experts as well will be joining in. Welcome back. Well, the markets are more or less steady, but Nimesh joins in now to tell us what is he picking up in terms of the dealing room action. Remember, we are holding higher. We have expiry as well that will play out in the next few minutes or so. The mid-cap index, well, that's doing relatively better today, and that's something that will make portfolios look quite good. The problem, though, is with the Nifty Bank. Now, that's on the verge of moving into the red, so just keep an eye out on that front. The Nifty Bank is now up only around 20 points. And that's a bit of a problem pocket. And we're making a bit of a down move, actually, closer to around that 18,800 odd mark. But Nimesh is all mic'd up now, and he's set to tell us what is he picking up. Nimesh, what are you reading about in terms of today's action?
Well, Nigel, the momentum is clearly with the bulls, and that's playing out again in today's trade. And look at the way, the participation is getting, bigger and bigger from many sectors now joining in. So today, technology is participating, cement is doing good. The real estate stocks are doing good in trade today. So a lot of sectors are now participating, and that's healthy because that's what you need towards the new all-time highs. That's what you need, larger participation, and that's playing out in today's trade. But unlike yesterday, yesterday was because of the MSCI, there was a large buy figure. That's not going to be the case today. The flows are mixed, is what I understand, and even towards the end, there's going to be a small market at close. But it's a mixed basket within the Nifty name. So that's the reason why I feel the numbers are not going to be that large from the larger institutions in today's trade. The other good part is that there is now participation in the broader markets as well. For second day running, the broader markets are outperforming, but there, I believe there is a bit of distribution as well. And some of the larger funds seems to be, using this opportunity to sell as well. So that's something to watch out for in the broader markets. There is selling supply coming in from the larger institutions. I guess even in the financials, while that's been a big leader in the last many weeks and months, even at these levels, there is a bit of mixed flows from the financials. So there is some bit of profit booking in the PSU bank stock, is what I understand from the larger institutions. So it's again, it's mixed from the large institutions. And as I said earlier, within the broader markets, this momentum has been used by some of the smarter funds to exit and sell some stakes. So that's something which has been a key takeaway. But broadly, the momentum is with the bulls, and the good part is there is participation now from larger sectors like cement, real estate, and IT. So that's a good part. But going to be a mixed day as far as flows are concerned.
Okay, flows mixed, but broader participation, that's something that the street will like. But individual stocks, Nimesh, what are you picking up?
Well, today the list looks very interesting to me. So the first stock is Timken India. You just look at the chart of Timken India in today's trade, big volumes and a big surge. The stock intraday was up 10%. And the first time, the indication was there is very strong buying support or buying interest in this particular stock from the larger institution. So at this price as well, there is a bit of interest back from the larger institutions. So that's why Timken India is buzzing in trade. The second stock is Ajanta Pharma. If you look at that chart, it's been consolidating in this narrow range. In fact, this month, the stock is down 4%. Today, there is a slight uptick. But in Ajanta Pharma, the feedback is that there's going to be a large block deal coming in Ajanta Pharma very soon. So that's something to watch out. The third stock is Voltas. After a long time, you've seen a bit of uptick in that stock as well. And the one key reason is, I believe, one of the leading long-only FI was a seller. That selling seems to be out of the way now, and hence you're seeing a bit of pullback rally in Voltas. It's pretty much close to the 50-week low, but from these levels, there is a bit of pullback, largely because a leading FI is sold out.
Thank you very much for that, Nimesh. Voltas was a stock which is very close to its 52-week lows very recently, as he pointed out, but there is some buying coming through. By the way, Oberoi Realty has also surged in trade. That's higher by close to about 4%. Earlier today, we had news that how Mumbai registrations for real estate for homes continues to be on an uptrend, 17% higher year-on-year, 4% higher on a month-on-month basis. So Oberoi Realty is largely present in the Mumbai market. There was a period in which the stock was underperforming on account of its Worli project and the kind of money that the promoters will be putting in to bail out the other promoter for the Worli project. But today, that stock has come in for some amount of buying. Let's get to Mitesh Thakkar. He's going to tell us a few trading ideas for the last 15 minutes. Mitesh, anything that's caught your attention?
I think a couple of stocks, Reema, which have, after correction now are gaining strength. One of them is Polycab. I think, after correcting from 2850 to about 2500, the stock is now clearly showing signs of some reversals. So that's a BTST with a stop at about levels of 2587 and a target of around 2640. And another stock is one which is making new highs continuously. That's Power Finance Corporation. That's a BTST with a stop just below levels of 137.5 for targets of 140 for tomorrow.
All right. Thanks very much, Amitesh, for that. We'll come back to you in a bit. 17 minutes to go for close, and we're up 50 points. It's almost as if, just look at the last 3-4 sessions on the trot, 40 or 50 points. In that range is the gain that the market finally ends up with. There are also sessions like yesterday when, of course, because of that last 30-minute surge, MSCI-led surge, the gains, of course, became pretty big. But otherwise, in this 40-50 slow, steady markets moving higher. Now, the Finance Ministry has proposed changes to the Insurance and IRDAI Act and sought comments on the proposed amendments by the 15th of December. What are these changes? We've been reporting on some of these as exclusive for the last couple of months. Yash is here with all the details. Yash, hi.
Well, Prashant, the only way you can address these proposals put by the Finance Ministry is by calling them game-changing reforms for the insurance sector. Comments from stakeholders on these reforms have been sought by December 15th, as you pointed out. Firstly, as far as amendments proposed in the IRDAI Act is concerned, there's one important part where the DFS, Department of Financial Services, says that whole-time members of the insurance regulatory body can hold office till the age of 65 years. Currently, that limit is 62 years. But the important reforms have come on the Insurance Act. Here, the first and the most important one is that the Department of Financial Services has proposed issuance of composite insurance business licenses. What's a composite insurance business license? It's essentially a common license through which one entity can operate both in the life insurance segment, general insurance segment, as well as standalone health insurance segment. Not just that, if an entity wants to do life insurance segment along with a sub-segment of general insurance, they can also do that, which means life insurance and motor, or life and health, and so on and so forth. That's going to be an important reform, changing the setup for the insurance sector in India. The second one is essentially distribution. Now, what Department of Financial Services has said is that insurers can distribute other financial products. The feedback from the industry is that other financial products can be mutual funds, loans, or even insurance products for other stream of business. So life insurance companies distributing health insurance products, for example. This opens up a new business and an income stream for these companies. The third one is minimum capital. Right now, to start insurance business, life insurance, health insurance, or general insurance companies have to deposit a minimum capital of 100 crore. Reinsurers have to deposit a minimum capital of 200 crore. That has been removed. Now it's the insurance regulator who will take a call, depending on the size and the scale of the business, how much capital is required to be submitted before they start their business. Also, as far as one proposal is concerned in terms of increasing your stake beyond 5%, if an entity holds 5% stake in an insurance company. Then after that, for every 1% addition, they have to take IRDAI approval. Now that won't be required all the way up to another 5%. So 5 plus 5, then you require an approval. Otherwise 5 plus 1, 5 plus 2, 5 plus 3, you won't need an approval from the insurance regulator.
All right, Yash, thanks very much for that. So there is a composite license which is getting stocks like LIC, etc. interested. Basically, any insurance company with their existing license can, enter life if they're not in life, enter general if they're not in general, all kinds of things, all kinds of possibilities. The question to ask, though, is, and this is something which I think analysts will be raising, if a company wanted to enter a particular line of business, would the formation of a company, just the requirement of formation of a new company have kept them back? Because it's not as if, the capital requirements, etc. have been lowered dramatically. It's just that you can conduct these other lines of businesses under the same roof, in one company. So that's the ease of doing business. But would that have kept away someone from, entering that segment if they really wanted to? I guess we should put some of that to companies over the next couple of days, and we'll do that. Now, it was a big mixed bag of sales for automakers in the month of November. The latest numbers are coming in from Mahindra & Mahindra and Maruti. M&M, of course, just came through. Mangalam is here with all the details. Mangalam, hi.
Well, the sum and substance of this month's auto sales is that domestic has been largely in line, if not better than expectations, but exports still continue to be weak. Passenger vehicles have done well on the domestic front. The SUVs have done even better. But at the same time, exports and there have been mixed trends coming for, commercial vehicles, both medium, heavy, as well as large commercial vehicles. So I'm looking at M&M, where the total auto sales have been at 58,300 units. This is slightly better than our poll of 57,600 units. And that's because domestic PV sales have grown by about 56%. Total three-wheeler sales also have been much better than expectations. But what was a hearty surprise was tractor sales. They were expected to be flat year on year, but domestic tractor sales have actually been 12% higher. The overall tractor sales have grown just about 10%, and that's because exports have reduced by 15%. Maruti as well, good domestic sales. The total sales have been around 1.59 lakh units. This compares with our pool of 1.68 lakh units. Out here too, the miss has been on the exports. The exports have fallen 7.7%, whereas domestic sales for Maruti have grown by about 18.8 odd percent. For TVS Motors too, the story is the same. The domestic sales have actually grown by about 2%, as far as exports have fallen by about 12%. What's done well for them, however, is the fast-growing EV business. From 699 units, it's actually crossed that 10,000 unit per month sort of mark in this time around. Tata Motors, we've seen it better than expectations. That's primarily because total domestic sales have grown by about 27%. PV sales in Tata Motors have grown by 55%, whereas commercial vehicles have declined by 10%. And that's where the mix comes by, because for Eicher Motors, the total VECV or Volvo Eicher commercial vehicle sales have grown by 20%. For them, Royal Enfield is the number that we'll be watching out for, most likely to be revealed post-markets or tomorrow morning itself. For Bajaj Auto, it's been a weak set. Total sales at 3 lakh units. The street was working with a number much higher, and that's primarily because exports fell by about 30% for them as well. Escorts Kubota did much better, 12% jump in their tractors business, and Ashok Leyland good numbers as well, 14,561 units as against street expectations of 13,600 units.
Thank you very much, Mangalam, for that. Mayuresh Joshi is also with us from William O'Neill and Company. Mayuresh, anything that stands out for you from the auto pack post these numbers?
Afternoon, Rima. So I think what Mangalam was mentioning and the numbers that came through for the month of November, a few stocks within the space itself are probably standing out at this point of time. Within the commercial vehicle pack, Ashok Leyland is trading above key pivot levels as we track it. And our own sense is that the kind of activity improvement that you probably see Q3 onwards, and the kind of model and product launches that they've done, specifically in terms of tippers and the last mile connectivity, expectation in terms of passing through of prices as well because of increased input costs. I think the margin stability has probably got maintained as far as Leyland's numbers are concerned. Market share, more or less, the very, very stable across quarters as we see. So I think Ashok Leyland trading above key pivot levels, and its assumptions of industrial activity improving with government capex increasing multiple over the next few quarters should hold this stock in good stead. The other number that probably stood out was also Escorts, as Mangalam pointed out. I think two things standing out again in terms of the farm equipment or the tractor business, the opportunities that come through in terms of the export markets, in terms of the horsepower of tractors itself. Below 50 HP, I think there is the major dominance that Escorts have at this point of time. Decreasing acreage of land that you probably see affects Escorts to a large extent in this subsegment itself. And railways with 900 crore order with better margins and a healthy overall balance sheet probably ensures return reliability, and the EPS RS rating remains extremely strong. M&F, the other one to probably watch out for, 3-4% from key pivot levels on the O'Neill lens. But I think a good all-around show as we see it, and the sum of parts in terms of their NBFC and the IT companies also add up to the overall valuation.
All right. Hi, Mayuresh. Afternoon. Mayuresh, we had the management of Monte Carlo yesterday who joined us, and they are talking about a 20-25% growth on the top line for this year. Margins are around 20%. Now, you are tracking the textile space as well. From there, what do you like? We have a lot of weddings. We have the festive season. The mood is back as well. What's your pick from that space?
Afternoon, Nigel. So absolutely, I think 32 shark weddings that are probably expected to go through the next few months. And cotton prices have come off. So I think one of the more important aspects for the entire sub-segment or the segment itself was that cotton spreads had gone through the roof 3 or 4 quarters back in time. But with cotton prices coming off, you're expected to see better spreads coming through. Now, vertically integrated companies within this space itself can do exceptionally well, is what I feel. Maybe I think a quarter or two, maybe might see some amount of margin miss. But with inventories coming off and with the newer inventories at lower prices, vertically integrated players, players like a Vardhaman, players like a KPR Mill, as an example, can over a period of time do well. Yes, they're lagging in terms of the O'Neill lens on the RS strength. But as that starts picking up, I think there can be significant traction there. On the Indian context itself, you're probably looking at $100 billion market within $1 billion market, sorry, Nigel, in the Indian context. And a large part of that is controlled in terms of the apparel market and around 20% by technical textiles as well. I was hearing the Monte Carlo management. The second half is obviously expected to be relatively better. But I think companies within these spaces, as I mentioned, with a relatively improving RS strength and vertically integrated, should command better margins, better realizations, and with lower amount of debt onto their books, the leverage should meaningfully play out. It might take a couple of quarters, as I said, but stocks like Vardhaman, KPR can get.
PSU banks are making a move higher. PNB, Bank of Baroda, pull them up for you on your screen, and you would see some traction there. Stay on. Mayuresh, need to get into a break. We'll come back with the closing levels as well.
Welcome back. Just 4 minutes to close. Mayuresh is with us. Mayuresh, look at names like L&T Technology Services, solid 9% gains on very large volumes, by the way. Usually when we have these overnight rallies on NASDAQ, I mean, there is rub-off, but not like this. This is a pretty large move on a large name as well. Any thoughts on this stock or the IT space?
So generally, I think it's seen a very good move from the bottoms, probably created a few weeks back. And the expectation largely is that IT as a defensive space should start holding out. Now, within the spaces itself, the larger outsources, like you mentioned, LTTS, LTI, and because of the corporate adjustments specifically on that front, you probably expected to see more revenue and cost synergies come through. Now, the extent of slowdown will actually determine the kind of order flows that will come through in quarter 4 for Indian IT companies as well, as far as the financial year is concerned. And therefore, I think we are adopting a wait and watch at this point of time. The ER&D companies, you've obviously seen huge bouts of correction in stocks like Tata LXI, but there is huge potential out there within the space itself. KPIT is one more stock where I think there have been multi-billion-dollar deals that have probably got announced. But largely, I think it's a very late-stage base on the O'Neill lens. Valuations still a little bit more on the higher side, in our opinion, when you probably stack up the 5 and 10-year median price earnings average as well. So yeah, I think good moves on the sector as a whole, but we're still continuing and maintaining a neutral stance at this point.
Okay, all right. So not entirely convinced that this is the move all the way higher. Maybe a bumpy road ahead. Mayuresh, thank you very much. Good speaking with you. Appreciate you joining in with that perspective. 45 points, by the way, on the Nifty. 18,800 plus is where we're going to end. Of course, I mean, from the day's high, it's a climb down. But I don't think anyone can complain or should complain or will complain. The high was, by the way, 18,890. And we are about 90 points off the high and a 0.25% higher. So 8th straight day of gains, and things have looked pretty good all the way. Banks, of course, were perhaps a little subdued, although that pace also after the dip came back up by close. The Bank Nifty, that is, mid caps and small caps. Mid caps did very well, 0.75% gain. Small caps were a little more subdued. It was largely a IT, metals, and PSU bank day. And in terms of large cap stocks, the Hindalco Tata Steel from the steel space, metal space, TCS, Tech Mahindra, Wipro, I'm not going into mid-cap IT, and the cement names, Ultratech and Grasim, all nifty names here. So, cement, steel and IT were the three big pockets of gains on the index. Prima.
Well, the mid-cap index finally outperformed. Mid-cap index up 0.7%. Advanced decline ratio had 3 stocks in the green for 2 in the red. All about mid-cap IT, L&T Technology, 9%, Birlasoft, 6%, Emphasis up 5.5%. Cement had a good session, JK Cement rallying close to about 4.5%. Rain Industries, another one in a similar space. In the last 30 minutes, we had up moves coming in from Oberoi Realty as well as PNB. So that pocket also looking up. On the losing side, IGL, GSPL, these are stocks which rallied yesterday on the liberalization of the gas norms which were out. Yesterday, they did well, but today they've come in for some amount of profit booking. And Shriram Transport is getting whipsawed on both sides. Yesterday, higher. Today, it's down close to about 5.5%. And a couple of these auto ancillaries like Bharat Forge came in for some weakness. Exactly at that 18,800 as the bell rung. We're up 42 points, higher for the 8th consecutive day. But we've lost ground from the top of the trading session, but still up close to about 0.23%. Cues to track today will be auto sales from some of the other numbers like Hero MotoCorp. And tomorrow, post-market hours, we will be tracking the US jobs data. With that, it's a wrap and closing bell. Don't go anywhere. Our Thursday special, big deal, comes up next.